For most of modern history, human commerce has operated on an information-insensitive baseline. When you walk into a store and pay with physical cash, you transact without a centralized authority verifying your identity, your political standing, or your credit history. That baseline of anonymous commerce is being dismantled. Global institutions are currently engineering an interlocking framework to digitize and tokenize both human identity and the natural world. While these initiatives are publicly framed as tools for sustainability and financial inclusion, they function as a massive apparatus for data extraction. Losing information in sensitive money means every purchase and movement must pass through an algorithmic checkpoint. Basic survival now requires centralized permission. One of the most complex components of this shift is natural capital accounting. This policy framework translates ecological processes, like the atmosphere's capacity to filter pollutants, into productive financial assets that can be managed on a balance sheet. In late 2023, the Intrinsic Exchange Group partnered with the New York Stock Exchange to push these assets into public markets. They proposed a new class of equities called Natural Asset Companies, or NACs. The proposal faced immediate resistance. A coalition of 25 U.S. state attorneys general identified NACs as a vehicle to transfer the monetization rights of public lands to private and foreign actors, effectively prohibiting productive activities like agriculture. The NAC framework commodifies the biosphere, mapping a forest's ecological outputs to overlay a digital grid of tradable financial instruments. While the NYSE withdrew the proposal in early 2024, the foundational architecture remains active. It provides a legal mechanism to permanently enclose and commodify the natural world for private capital investment. Managing tokenized assets requires absolute certainty over user identity. This necessity drives the global rollout of digital public infrastructure, a standardized architecture for biometric digital identity. This identity layer is heavily supported by philanthropic capital. The Bill and Melinda Gates Foundation provides the strategic funding for the MOSEP platform, helping nations rapidly deploy national biometric systems. Linking these digital identities to programmable central bank digital currencies creates a physical biometric tether. Your ability to participate in the economy becomes dependent on a centrally authenticated digital profile. China's eCNY already demonstrates this capability, enabling the state to execute highly targeted fiscal policies and behavioral surveillance via digital wallets. Meanwhile, Nigeria's e-Naira struggles to gain traction as a distrustful public resists the elimination of transactional privacy. The EU's digital euro highlights a specific paradox. Any promise of cryptographic anonymity is rendered void by the overarching surveillance requirements of modern anti-money laundering laws. Beyond consumer-facing digital currencies, a much larger restructuring is occurring at the hidden, wholesale level of international finance. The Bank for International Settlements is architecting a unified ledger, while the IMF promotes its XC platform. These initiatives aim to bypass the fragmented legacy of traditional banking by consolidating all assets onto a single, programmable operational layer. The core mechanism is atomic settlement. Tokenized reserves, commercial deposits, and government bonds are bundled and executed simultaneously across a single ledger. This consolidation removes payment delays, but requires absolute centralization of global liquidity data, enabling supervised AI to execute real-time compliance screening. Atomic settlement trades the decentralized resilience of legacy banking for a single point of absolute regulatory control. Once biometric identity and the unified ledger are integrated, geopolitical and regulatory compliance can be coded directly into the movement of capital. This enables automated financial weaponization. Nations or individuals can be mathematically excised from global liquidity without the need for complex legal enforcement. The supranational ledger transforms international trade into a rigid, algorithmically enforced digital prison. The ultimate result is the collapse of boundaries between money, nature, and identity into a single, monitored, tokenized state. Professor Richard Werner argues that this drive towards centralization is fueled by the modern mechanics of commercial banking, specifically the power to create money. Under fractional reserve banking, private banks create the vast majority of the money supply out of thin air when they issue credit. This newly created capital is predominantly directed towards speculative asset markets, inflating massive bubbles in real estate and derivatives. The tokenized unified ledger does not solve this misallocation of capital. It simply upgrades the system, locking in the power of legacy financial institutions. Werner proposes the sovereign money framework as an alternative. This system strips private banks of their money creation power and returns that prerogative exclusively to an independent, publicly accountable authority. To prevent central authority from becoming a monopoly, the allocation of credit is distributed to thousands of small, local investment banks. These entities are structurally incentivized to fund productive community output rather than global speculation. Fully digital ledgers introduce catastrophic single points of failure. They remain acutely vulnerable to cyber attacks, power grid failures, and localized internet outages. Preserving physical currency and localized banking serves as the ultimate failsafe, ensuring human autonomy survives even when the digital grid goes dark.